Scooby-Doo ba 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 da ba da ba ba. Skibidi-doo boom boom ba. Today the topic will be on stocks. Around me right here you can see different business establishments. You have the Fox Theater there. And you have Luca Jazz Center right there. And behind me, right there, that is the downtown area. Whoop, right there. That's the downtown area. So in the downtown area, like I mentioned, you have larger corporations such as AT&T, and you'll see other big name companies out there. That's usually where they reside. And down in these areas, you have more of the local stores, the mom and pops, the small businesses. Now, with stocks, we'll start off by talking about the difference between these two types of organization. And really that's going to lead in nicely with the 5 steps for, starting off investing and trading stocks. So with your mom and pops, like you have with the Fox Theater and this other store, Luca, they're privately owned. Being privately owned, I think they're privately owned. They're local, small, privately owned. They don't have to necessarily be small, but the fact is they're privately owned, and that organization makes the decisions. They decide how money will be spent, what they're going to do with their revenue. Whoo, it's loud. Actually, you know what? I'm gonna go to the park. So they decide what to do with their revenue and the money that they make. You go to these places, you go to the Fox Theater, you go to any of these places, you pay X amount of dollars for whatever services they provide, and they take that money and then they use it for operations and disperse that profit between their workers and such. Now with public owned companies, which would be something like AT&T and some of these other big companies, is the ownership is spread out between shareholders. And shareholders are people who have some investment in the company. Now, if you own a stock with a publicly owned company, you're an owner in that company and you have a say for how that organization operates. Now, the larger of a share you have with that company, the higher or more say you have in that company. So those are your majority stockholders or shareholders. With these two companies, even though they vary in how they are managed, essentially their goal is to make money. They want to make profits. So that's essentially the goal for these companies. Now, where you come in as an investor, because that's what you'll be. You're an investor if you're putting money into any of these companies. Now, with a private company, you're limited. You might not be able to invest in that company because it's a privately owned business. It's like a mom and pops. Now, if you want to be a private investor, you could have a relationship with that company and say, hey, I give you X amount of dollars, and if you make a profit, I want a share of that. And that will be how that will be operated. And most people are unable to do that. Now, most likely where you will be trading that is with these public companies. And with the public companies, you give X amount of dollars, and in return for investing in that, if they make a profit, you get a percentage of that. Now, what drives that? There's multiple factors. But really what you're looking at and what you should be interested in as a newcomer into investing is the stock price. So the stock price is determined by a lot of factors, but essentially it boils down to supply and demand. The new Drake album came out. Now in the first, and let's just say for any album, in the first week, there's usually a high demand for that album. That's where you see a lot of the streams or purchases. A lot of people want to hear it at that point. Now, as time goes by, you don't hear of it as much. Not as many people are, not that they're not interested, but the demand is lower. Now, in that early stage, when the demand is so high, realistically, you can ask for a higher price. That's where you usually see it at the retail value. And then usually when the demand goes down, then you see it become discounted and the price becomes lower because not as many people want that product anymore. So to continue getting more sales, the price drops. Now with stocks, you can think of it this way. Let's use AT&T for an example, as we've been doing. With AT&T, if AT&T is popping, for lack of a better word, if they're being successful, a lot of people are interested. There's a high demand for it, and that high demand will drive your stock price up, the share price. So let's say it's trading at $20. If they're doing really well, let's say they announce their quarterly earnings, how much they made in a quarter, and it's really high. Now a lot of people are like, oh man, we need to get on top with AT&T. Now the price is going to increase maybe to $25 to $30. Regardless of what that is, that represents some percentage. Now, depending on how much you have invested in that company, your money is going to change X amount of percentage. So if it went from $20 to $25, that is around 5%. Sure, let's call it 5%. It's less than that, but let's call it 5%. Now, if you put $100 in that and you had a 5% increase, that is going to be $5. So you earn $5 from that company. I think so. My math is way off. Regardless, you get a 5% increase in your money. Now let's say AT&T had a bad earnings and they dropped 5%. Guess what? You lose 5%. So essentially with stock trading, you're gambling because there's a potential that you could win or you could lose your money. And really that's a risk. Now you have more stable companies like AT&T, you know they're solid. They've been around for a long time. So that's more of a solid bet that they're not going to lose your money, that most likely it will be stable, versus let's say a new company, even something like Tesla. Tesla's, they call this volatility. Someone like a company like Tesla, you might see there's more risk with that, associated with that, because they're not as established and they're still building themselves. So there's a risk that you could lose more money, but there's such a high demand for Tesla that the price stays high. So it's a risk that yields high results. Or you can say it's a risk worth taking, risk it all. Whereas with a more stable company like a McDonald's, that's a company where, or AT&T, they've been around for a while, so you might not see a big spike, but it's a low risk. So it's a low risk, but low reward, but it's stable. So these are the two different types of investments that you can see, or types of trading you can do with a stock. You can do some of these high risk, high yield, or you can do a low risk, low yield, something stable. How you go about with that, that's up to you. As a starter, always go with the low yield, low risk options. Low risk options, companies that are stable, AT&T, McDonald's, or something like that. Now I know I'm using these companies as an example, but you can use anything else. As for me, I'm speaking from experience, and from my experience, what I did, I know a lot about tech. I really enjoy technology, and I follow a lot of the companies, so I know what's going on, what's in your chips, the chips that are in your devices, the parts, the components that are in there. Intel is a company that has its foot in almost every devices that you are using, whether it's through the modem or the CPU, as in the computer. So I know regardless of if, let's say, Windows or Apple is doing good, regardless of that, Intel is going to be doing good because they're supplying the chips to both companies. Whereas if you put your money in Windows and Windows not doing good, guess what? Now you're not doing good. So I went with Intel as my first company that I invested in, and it was stable. It was a low risk, low yield company. It did yield me a good amount of percentage, but not to the extent that some other company would have, and it was stable. It's an established company. So that was a safe and smart decision that I did. But of course, depending on what your area is, you might choose to go differently. So with that aside, so what are we saying now? Stock trading, you have your public companies, and essentially you're gambling, you're betting on them that they're going to be popping or not. And you want to bet on them right before they become popping. Now, if you know Drake was about to drop that album, there's a lot of hype being built around that. Let's use that word, hype. You want to, sometimes you follow the hype, and usually the hype will lead you to that profitability or your gains. Now, leading up to Drake's release of that album, there's a lot of hype being built, a lot of expectations, and in that raising of expectation, usually what you'll see is the stock price being increased. Let's say the album came out, reviews come in, they're bad. Man, Drake fell off. Guess what? You're gonna see Drake's stock crash, all right? And you see it drop significantly. So that is roughly using Drake as a way to kind of understand what goes on with this trading process. With that said, I don't think there's anything else I would say about trading stocks. That's essentially what it is. It's supply and demand. How much do people want that stock, and how much of it is out there? And remember, when you're buying a publicly traded company or you buy a stock, you own part of that company and you're involved in the decision-making process. Depending on how much of that stock you have more of a say on what the company does. If you own 50% of the company or you own 50% of the stocks, you have a greater say in how the company operates.